Most people don't truly understand just how fragile the global financial system really is. Many assume it's strong, complex, and expertly managed, that behind the scenes, professionals have everything under control. But the reality is far more delicate. The system runs on trust, confidence, and assumptions that only hold as long as no one questions them. But the moment someone does, everything can shift fast. That's exactly what happened when Moody's, one of the major credit rating agencies, downgraded the credit rating of the United States. It was just a single notch, a one-level cut, but it was a critical move because it stripped the U.S. of its last remaining AAA rating. That AAA was more than a symbol. It was a gold standard, representing the highest level of creditworthiness. Now that it's gone, the consequences are starting to show. Some in Washington may not have expected this, or perhaps they saw it coming and hoped it wouldn't cause serious damage. But it is serious damage in real time. Financial markets react at lightning speed to news. But the rules that govern global money flows move even faster, because they're written directly into regulations. Take Hong Kong, for example. Its Mandatory Provident Fund, managing $166 billion in retirement savings, has strict rules about how much can be invested in bonds from countries without the highest credit ratings. This isn't about market panic or investor sentiment. It's about compliance with the law. So when two of the three major credit rating agencies lower the U.S. Treasury's rating, the rules kick in. Funds like Hong Kong's are required to reduce their holdings of U.S. bonds. They don't have a choice. They must sell. And if Japan's rating agency follows with downgrade, it could trigger even more forced selling. That could mean as much as $63 billion worth of U.S. bonds being dumped by Hong Kong alone. While that may seem small compared to the U.S. debt, which sits in the tens of trillions, it sets a dangerous precedent. Once one major fund is forced to sell, others may have to follow. Not because they want to, but because they're legally obligated to. If they don't, they risk violating their own rules and breaching fiduciary duty. This is exactly how cracks in the financial system start to spread. Meanwhile, China isn't just sitting by. It's building something different, a financial system designed to compete with the U.S. For instance, a major Chinese EV battery company, KDL, recently raised $5.3 billion through a stock sale in Hong Kong. This happened despite the U.S. government blacklisting the company. The IPO was a huge success. The stock jumped 16% on the first day. Why? Investors weren't supporting Chinese politics. They were chasing profits. KDL supplies more than a third of the world's EV batteries, working with companies like Tesla, Mercedes, and Ford. As electric vehicle demand skyrockets, so does demand for TEL's products. This is a key shift. Investors aren't looking at flags or slogans. They're looking at performance. And China is turning its industrial strength into financial power. It's actively growing strategic sectors like semiconductors, green energy, and logistics, with firm government support and clear regulations. The result? A well-paved path for business growth and profitability. In contrast, investors in U.S. debt are growing cautious. The average maturity of U.S. debt held by investors has dropped below 6 years, a sign of shrinking long-term confidence. In effect, the message is, we'll lend to you for now, but we're not committing long-term. At the same time, lenders are demanding more interest to compensate for rising risk. Yields on 30-year U.S. government bonds have climbed to nearly 5%, the highest level since 2007, right before the last major financial crisis. The bond market is sending a clear message. We'll lend, but we don't believe you have this under control. Even Ray Dalio, renowned for his calm, long-term investing strategy, has warned that the biggest risk isn't default but inflation. If the U.S. pays back its debt in dollars that are worth less, trust erodes even without a formal default. Now consider the scale of the problem. The U.S. Treasury plans to borrow an additional $2 trillion this year alone. As interest rates rise, the cost of servicing this debt balloons. Interest payments could soon exceed what the government spends on Medicare, or even defense. And it gets worse. A new tax bill, supposedly deficit neutral, could actually add between $3.4 trillion and $5 trillion to the national debt over the next decade, according to Yale University and Congressional Budget Office. So while debt is rising, interest rates are climbing, and tariffs are choking off imports, which means fewer dollars circulating globally and fewer foreign buyers for U.S. debt. The entire system is starting to buckle. This isn't theoretical. This is happening now. Before all this, the system worked like this. The U.S. bought goods from other countries. Those countries, in turn, used the dollars they earned from exports to buy U.S. government bonds. The U.S. then used the money from selling those bonds to fund more spending. It wasn't perfect, but it kept dollars circulating globally and maintained steady demand for U.S. debt. Now that cycle is breaking. Tariffs are disrupting the flow. Fewer imports mean fewer dollars are leaving the U.S. and circulating in foreign economies. Fewer circulating dollars mean fewer foreign buyers for U.S. government bonds. At the same time, people around the world are starting to question how responsibly the U.S. is managing its finances. That doubt shows up in headlines, in bond market behavior, and in behind-closed-door conversations among investors. And while this uncertainty grows, China is offering an alternative. It's presenting a financial system backed by deliberate government planning, rising industrial output, and clearly defined rules. In just the first 3 months of 2025, China's financial support for its domestic economy topped $2 trillion. The number of companies listing on Chinese stock markets jumped 38% compared to the previous quarter. Key sectors, electric vehicles, semiconductors, and logistics, aren't just growing. They're being actively supported by the government to attract global investment. And it's working. According to Goldman Sachs, foreign investment in China's stock markets reached $47 billion last quarter, more than double the figure from the same period last year. Why are investors doing this? Not because they support China's politics. They're chasing predictability. Right now, China offers something the U.S. increasingly doesn't: stable rules and reduced political risk. As investment giant Bridgewater put it, China is being rewarded not for freedom, but for stability. Investors aren't focused on ideology. They're focused on protecting their capital. They don't want to worry about government shutdowns, debt ceiling standoffs, or unsustainable deficits being treated as business as usual. If Japan's credit rating agency also downgrades U.S. debt, that would automatically trigger a $63 billion forced sale of U.S. bonds by Hong Kong's pension system. Not because of panic, but because the rules require it. And if other countries have similar rules, this could snowball into a global chain reaction. Even a modest 3% reduction in U.S. Treasury holdings globally could lead to more than $200 billion in forced bond sales. That alone could push interest rates up by half percentage point. This isn't hysteria, it's arithmetic. What's most concerning is that this may only be the beginning. It's a preview of what happens when confidence in the U.S. dollar as the world's primary reserve currency starts to slip. When investors stop trusting the government's ability to manage its debt, the foundation starts to crack. At that point, the national debt is no longer just a number. It becomes a critical variable in an equation that could cause the entire financial system to unravel. If foreign investors begin pulling their money out, not out of anger, but as a rational decision to protect their portfolios, the U.S. won't just face rising borrowing costs. It will face the loss of its position as the anchor of the global financial system.